Right now, there are 35,000 tons of gold sitting in central bank vaults around the world. And based on the math, the real math, not the math they teach in business school, every single ounce of it is undervalued by a factor of more than 16, not 16%, 16 times. Let that sink in. Gold closed last week near $3,400. Multiply that by 16 and you get $5,400. But that is the conservative number, the number that does not account for what China, Russia, and the BRICS bloc are quietly building right now, a gold-backed monetary architecture that would require Western central banks to reprice their reserves to support the new system. When you run those numbers, and I'm going to walk you through every single one of them today, the figure that comes back is not $10,000, it is not $20,000, it is not even $50,000. The figure that comes back is $75,000 per ounce. And no, this is not clickbait, this is arithmetic. And the arithmetic does not care whether you believe it or not. If your savings are in dollars, if your retirement is in dollars, if your wealth is denominated in the currency that 120 countries are now actively trying to replace, you need to watch this entire video, because what I am about to show you is not a theory, it is a timeline. And based on the data we have right now, that timeline is accelerating faster than almost anyone in mainstream finance is willing to admit. Welcome to the hidden economy. The real story is never on the surface. Subscribe right now, because the analysis in this video is the kind of thing the mainstream financial press will not run until after the move has already happened. Now, let me show you the number that started all of this. $6 trillion, that is the current US national debt as of this recording. But that number alone does not tell you the full story. The number that matters, the number that unlocks everything, is the ratio between the US money supply and the official US gold reserve. Here's how this works. The United States government claims to hold 8,133 tons of gold at Fort Knox, West Point, and the Federal Reserve Bank of New York. That is approximately 261 million troy ounces. The official US government valuation of that gold, 42.22 per ounce. That valuation has not changed since 1973. 50 years ago, the government is still carrying its gold on the books at $42 an ounce, while gold trades in the open market at $3,400. That is not an accounting error. That is a deliberate fiction. And the fiction is load-bearing. It holds up a system that could not survive honest numbers. Now here's where it gets interesting. The M2 money supply, the broadest measure of dollars in circulation, currently sits at approximately $21, $7 trillion. Divide that by 261 million ounces of gold and you get a shadow gold price. The price gold would need to be to fully back the existing dollar supply, just for the United States alone. That number is approximately $83,000 per ounce. $83,000 for the US alone, before you add Europe, before you add Japan, before you account for the Eurodollar system operating offshore, before you add a single dollar of the $33 trillion in outstanding Treasury debt that is currently being monetized at a rate that has no historical precedent. I am not saying gold goes to $83,000 tomorrow. What I am saying is that the system already requires gold at that price to be mathematically honest. The gap between where gold is priced and where it needs to be priced is one of the largest distortions in the history of modern finance. And that gap is closing. But that is not the part that should concern you most. The US situation is a problem, but the US situation is also known. It is documented. There are thousands of analysts watching American debt metrics in real time. What they are not watching, what the mainstream financial press has been systematically ignoring, is what is happening on the other side of this trade. The East is not confused about what gold is worth. In the last 24 months, China's People's Bank has officially added over 316 tons of gold to its declared reserves. Russia has added more than 200 tons since Western sanctions began. Kazakhstan, India, Poland, Turkey, all adding. Saudi Arabia, whose sovereign wealth fund now manages over $900 billion, quietly accumulating. The BIS, the Bank for International Settlements, the central bank of central banks, reclassified gold as a Tier 1 asset alongside cash and sovereign debt in 2019. Paper says gold is a commodity. The vault says something very different. Central banks bought more gold in 2022 than in any year since 1967. They bought more in 2023. And the 2024 and early 2025 numbers, as reported by the World Gold Council, show the pace is not slowing, it is accelerating. These are not retail investors. These are not stackers. These are not people watching YouTube videos. These are institutions that manage the monetary reserves of sovereign nations. And they are all doing the same thing at the same time. Moving out of dollars, moving into gold. Once you understand the ratio, the price action makes sense. Now let me give you the specific data points that the mainstream will not connect for you. Because individually, each one of these numbers looks like a curiosity. Together they form something that is very hard to look away from. Let me take you to January 2025. The COMEX, the primary futures exchange where gold is priced in the Western financial system, began experiencing something unusual, a surge in delivery requests. It's not traders rolling their contracts forward, which is normal, traders standing for delivery, taking the metal out. In January and February of 2025 alone, over 1,200 tons of gold were transferred from London LBMA vaults to New York COMEX vaults. 1 in 200 tons in 2 months. Why does that matter? Because the LBMA, the London Bullion Market Association, is the heart of the global gold leasing and lending system. It is where central banks park their gold and quietly rent it out to earn a return. It is where the fractional reserve gold system lives. The estimates on how much gold the LBMA has leased out versus actually held vary, but credible analysts, including former Federal Reserve economists, have suggested that a significant portion of Western central bank gold has been leased out multiple times, creating a paper claim structure similar to what we see in silver. The flow from London to New York was not normal market behavior, it was a signal. Someone, or multiple someones, did not trust the London system to deliver when asked. They wanted metal on American soil, under American jurisdiction, where they could actually verify it existed. And then something strange happened to the vault numbers. London gold lease rates spiked. In a normal, well-supplied market, you can lease gold for 0, 1% to 0, 5% annually. In late January 2025, short-term gold lease rates briefly hit 5%. That is not a data quirk. That is a screaming alarm that physical gold available for immediate delivery had become acutely scarce. But here is what should really disturb you. The Basel III Accords, the international banking regulations that govern how banks calculate risk, came into full implementation in Europe and the UK in January 2022. Basel III reclassified gold from a Tier 3 asset, requiring a 50% haircut, to a zero-risk Tier 1 asset, fully equivalent to cash and government bonds, but only for physical allocated gold. Not paper gold, not leased gold, not unallocated accounts. Physical, allocated, sitting in your vault gold. This is not a small regulatory footnote. This fundamentally changed the economics of holding physical gold versus paper gold for every major bank in Europe. Banks that previously had no incentive to hold physical gold now had every regulatory incentive to move into it, and they did. They have been doing it for 3 years. Wall Street is not confused. They know exactly what this means. This is Basel III, forcing the unwinding of decades of paper gold supply. This is the structural framework that turns a long-term suppression scheme into a long-term repricing event. And the repricing has only just begun. Let me show you the historical precedent, because this is not the first time this movie is played. 1971, Nixon closes the gold window. The US unilaterally ends Bretton Woods. Gold had been pegged to $35 an ounce. Within 9 years, by 1980, gold hit $850 per ounce. That is a 228% increase in less than a decade. Not because gold became more useful, because the dollar became less trustworthy, because the market eventually repriced gold to reflect the monetary reality that existed all along. Same playbook, different decade. In 1974, the US government made gold legal to own again for American citizens. It had been illegal since 1933. The gold market was closed to retail for 41 years. When retail came back in, price went from $35 to $850. Think about who held gold during those 41 years when retail was locked out. Institutions, governments, the people who write the rules. And they accumulated at $35 while an entire generation was legally prevented from doing the same. Who is locked out today? Who is being kept away from gold by financial advisors telling them it is a relic? Who is being told to trust the dollar, trust the bond market, trust the system, while central banks are buying gold at the fastest pace since before Nixon? You are watching this because the mainstream won't show you the full picture. Let me walk you through the BRICS gold architecture, because this is the part where the $75,000 number stops being speculative and starts being mechanical. In August 2023, the BRICS summit in Johannesburg formalized something that had been building for a decade. A framework for bilateral trade settlement in local currencies anchored to commodity baskets, with gold as the reference asset. Not a gold-backed currency in the Bretton Woods sense, something more flexible, more opaque, and in many ways more threatening to the dollar system, a parallel settlement architecture that does not need the dollar at all. By early 2025, over 50 countries had applied or expressed interest in joining BRICS or its affiliated payment systems. The BRICS nations collectively represent approximately 36% of global GDP at purchasing power parity. They represent over 45% of the global population. They produce the majority of the world's oil, rare earths, agricultural exports, and industrial metals. And they are pricing their transactions in gold-referenced units. Here's what that does to the gold price. Right now, approximately $7. $5 trillion in global trade is settled in dollars annually. If even 20% of that migrates to gold-referenced settlement over the next decade, it creates a new, structural, non-discretionary demand for physical gold that does not exist in the current pricing model. Not investment demand, not speculation. Transactional demand, demand that does not care about price, demand that has to be met. The paper says gold is a portfolio hedge. The vault says gold is the next reserve asset. And here is what filed at the IMF that nobody is talking about. In the IMF's most recent COFA data, currency composition of official foreign exchange reserves, the dollar's share of global reserves has fallen from 71% in 2000 to approximately 58% today. That is a 13 percentage point decline in 24 years. The pace is slow, but it is consistent, and it is accelerating. The 2022 Russia sanctions, where $300 billion in Russian dollar reserves were frozen overnight, did not slow this trend. It turbocharged it. Every central bank with dollar reserves watched what happened to Russia in 2022 and asked the same question. What happens to our reserves if we ever cross Washington? The answer accelerated every gold purchase program that followed. The gap didn't close, it widened. Now let me connect COMEX to the BRICS accumulation pattern and show you why the Western pricing mechanism is increasingly disconnected from physical reality. The COMEX gold futures market currently has open interest representing approximately 38 million troy ounces of gold. That is roughly 1,183 tons. The amount of gold in COMEX registered vaults, the gold that is actually available to deliver against those contracts, is approximately 11 million ounces as of recent filings. That is a 5-to-1 ratio of paper claims to registered physical. But here is where it gets worse. Of that 11 million ounces in registered vaults, an estimated 80 to 90% is held in warrant by institutional investors who are not willing sellers at current prices. They are holding for long-term appreciation. The effective deliverable supply, gold that is both registered and owned by entities willing to sell at spot, is closer to 1-to-1, 5 million ounces against 38 million ounces in open interest. That is a ratio of approximately 25 to 30 paper ounces for every real deliverable ounce. This number doesn't exist in a fair market. In a fair market, if you cannot deliver, you do not sell. The only reason a 25-to-1 ratio persists is because most people never ask for delivery. They trust the paper, they roll the contract, they never call the bluff. But central banks are calling the bluff. The flow from London to New York in early 2025 was central banks calling the bluff. The 316 tons China officially added is the public number. Private accumulation through the State Administration of Foreign Exchange is estimated by several intelligence and financial research firms to be multiples of the official figure. China's official gold reserves are listed at approximately 2,300 tons. Analysts at Gold Switzerland and Jan Nieuwenhuis, who tracks physical gold flows through Swiss refineries and customs data, estimate China's total gold holdings, official and unofficial, at between 20,000 and 30,000 tons. If that number is even directionally correct, it changes every calculation about the dollar-gold exchange rate in a post-dollar world. Once you understand the ratio, the price action makes sense. The premium between Shanghai gold prices and London gold prices has been persistently positive for the last 3 years, often running $30 to $60 per ounce above the Western spot price. This is not noise, it is the East outbidding the West for real metal in real time. The West is still pricing this like 2019. The East is pricing it like the monetary system is changing. Because it is. Let me tell you what happens next. Not as a prediction, as a sequence of events already in motion that cannot be reversed without dismantling the entire institutional architecture that has been built around gold accumulation for the last decade. Step 1 has already happened. Central banks reclassify gold. Basel III delivers the regulatory framework. The financial plumbing of the Western banking system starts favoring physical gold over paper claims. This step is done. Irreversible. Step 2 is in progress right now. Dollar reserve share continues to decline. BRICS settlement framework expands. More bilateral trade avoids dollars. Gold-referenced unit frameworks deepen. Each new trade deal signed in non-dollar terms is one less reason to hold dollar reserves. This step is accelerating. Step 3 is the event that forces the repricing. And here is where I want you to pay very close attention. At some point, and based on the data, that point is measured in months to a few years, not decades, a major sovereign nation will publicly announce a partially gold-backed currency or bond. Not full Bretton Woods, just enough. Just 10%, 20% gold backing. Just enough to signal that the debt of that nation is harder than dollar-denominated debt. When that happens, every other major creditor nation will face a choice. Accept a progressive devaluation of their dollar holdings or revalue their own gold reserves to compete. The United States will face the same choice. The $42.22 per ounce fiction on the Federal Reserve's balance sheet will become politically and economically untenable. A revaluation of US gold reserves to market price, which every serious monetary economist will agree is the technically correct accounting, would add approximately $875 billion to the Fed's balance sheet at $3,400 gold. Every $1,000 increase in the gold price adds another $261 billion. At $75,000 gold, the US gold reserve is worth approximately $6 trillion. That is enough to back a significant portion of the existing money supply. That is enough to credibly anchor a new dollar, a dollar that can compete with whatever the BRICS architecture has built. That is the escape hatch. That is the managed transition. And the people who hold gold before that transition are the people who transfer wealth instead of losing it. This is not a new story. It played out in 1933 when Roosevelt confiscated gold at $20. $67 an ounce, and immediately revalued it to 35s, a 69% overnight devaluation of every dollar. It played out in 1971 when Nixon closed the gold window and every dollar holder watched their purchasing power erode by over 80% in the decade that followed. Once as accident, twice as coincidence, 3 times as policy. Here's what filed at the Treasury that nobody's talking about. The Exchange Stabilization Fund, the ESF, a Treasury slush fund with minimal congressional oversight, currently holds $39 billion in SDRs, foreign currencies, and gold. The ESF has been used historically to intervene in currency markets without disclosure. It was used in the 1990s Mexican peso crisis. It was used during the Asian financial crisis. Its gold operations are specifically exempt from audit requirements that apply to other government accounts. Nobody knows exactly what the ESF has been doing with gold for the last decade. What we do know is that Fort Knox has not had a full independent audit since 1953. Not 1973, not 2003, 1953. The gold that backs the dollar, the gold that is carried on the Fed's books at $42 an ounce, the gold that is supposed to exist in Fort Knox, has not been independently audited in 71 years. Paper says the gold is there. The vault has not been opened. Now let me tell you who gets hurt. Not the people who own gold, not the central banks of China and Russia who have been accumulating for years, not the institutional investors who moved into physical following Basel III, not the stackers, the sovereigns, the patient money. The people who get hurt are the people holding dollar-denominated paper wealth in a world where the dollar is being systematically displaced. The people in 401ks fully invested in dollar assets. The people holding treasury bonds that will be repaid in a currency worth a fraction of what it is today. The people who trusted the financial advisor who said gold is just a commodity, it pays no yield, it is a relic. There are 3 types of people watching this right now. The first type will dismiss this as doom content. They will say the dollar has survived before. They will say these predictions have been made for decades and they were wrong. And they are not entirely incorrect. The dollar has survived. But survival at the cost of 96% purchasing power loss since 1913 is not the same as stability. The frog does not notice the water getting hotter. The second type is frozen. They understand something is wrong. They can feel it in grocery prices, in rent, in the impossible math of retirement projections, but they do not know what to do. They are paralyzed between conflicting narratives, afraid to act, afraid not to. The third type understands the ratio. They have run the numbers. They know that the gap between $3,400 gold and $75,000 gold is not a prediction. It is the mathematical consequence of the monetary decisions that have already been made. They are not panicking. They are not selling. They are not waiting for permission. They are positioned. You are watching this because the mainstream won't show you what the third type already knows. Now let me address the most common objection, because I want to be honest with you, not just persuasive. The objection is governments will not allow it. If gold repricing threatens the dollar system, Washington will intervene. They will restrict ownership. They will tax gains. They will do what Roosevelt did in 1933. It is a legitimate concern, and I will not dismiss it. Here is what I will say. The 1933 confiscation happened in a world where the United States produced 40% of global GDP and had no serious monetary competitors. It happened before digital assets, before offshore storage, before Swiss vaults, before Singapore, before Dubai. It happened before the internet made financial knowledge universally accessible. The 2025 geopolitical reality is completely different. Any aggressive move to suppress gold ownership in the United States would accelerate the de-dollarization it was meant to stop. Foreign central banks holding dollar reserves would read the signal immediately and accelerate their gold purchases. The cure would be worse than the disease. This does not mean the risk is zero. It means the calculus has changed. Wall Street is not confused. They know exactly what this means. Goldman Sachs, which spent years telling clients gold was overvalued, published a research note in early 2025 with a $4,500 gold target by end of year. JP Morgan has published analysis suggesting $5,000 gold in a moderate de-dollarization scenario. Even the IMF, the institutional guardian of the dollar system, has published working papers exploring the implications of gold's return to monetary relevance. These are not fringe voices. These are the institutions that built the paper system acknowledging, quietly in footnotes and working papers, that the math no longer works. They just are not telling you the destination. They are telling you the next stop, not the terminus. The premium held through the entire dump. Every time the Fed has tried to signal dollar strength, every rate hike cycle, every hawkish pivot, gold has absorbed the selling and resumed its climb. The 2022 rate hiking cycle was supposed to kill gold. The fastest rate increases in 40 years. Gold ended 2022 up and then started 2023 at $1,900 and ran to over $2,600 by year end. 2024 saw gold break $3,000 for the first time in history. The paper keeps selling, the physical keeps disappearing. If you are already holding physical gold, you understand something fundamental. The price you see on a screen is not the price the world will pay in 5 years. You are holding a measurement of the distance between where things are and where they have to go. If you are not yet positioned, if you are watching from the sidelines, if you are waiting for a pullback, if you are still trusting that the system will take care of you, I want you to do one thing before this video ends. Go look up the purchasing power of $1 in 1971 versus today, not as a metaphor, as a mathematical fact. $1 in 1971 has the purchasing power of approximately 6 cents today. That is not inflation. That is a 94% loss. That is what happens to paper currency when it is not constrained by anything real. Gold is the constraint, always has been. And the world, whether the Western financial system is ready or not, is moving back toward it. This is not financial advice. Your money, your decisions, I am not a financial advisor. What I am is someone who does the math and shows you what it says. And the math says $75,000. Not because I am optimistic about gold, because I am doing arithmetic about dollars. Now let me leave you with a specific number that closes the loop on everything I showed you today. May 5th, 2025, that is the date of the next US Treasury refunding announcement. The quarterly document where the US government tells the market how much new debt it needs to sell. The last 3 refunding announcements came in higher than forecast. Each one required the Federal Reserve to either absorb supply or watch yields spike. Each one moved the gold price. The May announcement will tell you whether the debt trajectory is stabilizing or accelerating. If it comes in higher than the consensus forecast, as the last 3 have, the mathematical case for gold repricing becomes harder to dismiss on any timeline. Screenshot this. Come back after May 5th. The question that this video cannot answer, the question that the next video will address directly, is this. When the repricing happens, when gold moves from $3,400 toward its monetary equilibrium, what happens to silver? Because if gold goes to $75,000 and the historical gold-silver ratio of 15-to-1 reasserts, even partially, what you are looking at for silver is a number that the mainstream financial press has never once printed. And I will have that analysis ready before the May refunding window closes. Drop a comment right now with your gold price target for 2026. Tell me what number you are watching. I read every single one. If this video showed you something the mainstream would not, share it. Send it to one person who is still trusting the paper. Most people will never see this analysis, but you did. Now help someone else see it. Subscribe to The Hidden Economy. Hit the notification bell. Because what comes after May 5th, based on everything I just showed you, is not a story you want to miss mid-chapter. The US national debt is $33.6 trillion. The gold backing it is priced at $42 an ounce. The gap between those two numbers is not a policy option. It is an inevitability. $75,000 gold is not a prediction. It is the math resolving. This is the hidden economy. Because the real story is never on the surface.